Coming up on Market to Market. The battle to contain western wildfires rages on. Intense summer heat pounds the nation's midsection, and the legacy of a popular New Deal program runs deep. Those stories and market analysis with John Roach, next.
This is the Friday, August 30 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Steady growth and a positive attitude among consumers were bits of good news as the economy continues its bumpy 5-year recovery from the Great Recession. According to the Commerce Department, second quarter gross domestic product, the broadest gauge of the U.S. economy, grew at an annual rate of 2.5%, higher than previously anticipated. Consumer confidence increased in August as positive job and earning prospects joined with an upbeat business outlook to push the index to its highest level in 2.5 years. Consumer spending, which accounts for 70% of economic activity, grew by 1.8% in the second quarter. Overall wages and salaries tumbled from June, causing some economists to worry about prospects for third quarter growth. Despite the mostly positive economic news, the threat of U.S. intervention in Syria moved the price of oil over $112 per barrel midweek. But by Friday, oil settled just above $107 as the prospect of an immediate attack diminished. And officials with the USDA say net farm income is expected to reach $120.6 billion this year. If realized, it would be the second highest amount since 1973, but 6% lower than predicted in February. It has been a tough weather week across the nation. A dome of high pressure settled over the Midwest, creating a late-season heat wave that continues to bake precious moisture out of the soil. Nowhere has that lack of moisture been felt more than in the West, where a fire the size of several major metropolitan cities has been burning for more than 2 weeks.
Fire crews in the Sierra Nevada mountain range are making progress. However, the giant wildfire is still growing. The nearly 2-week-old rim fire burning in and around Yosemite National Park is barely 30% contained and has left more than 300 square miles of scorched earth in its wake. The wildfire, larger in size than the city of Chicago, is spreading through rugged forest, but its progress is being slowed by cooler temperatures and lighter winds.
The situation in this fire is that it's burning hot and it's burning in the crown. When a naturally recurring fire happens in a forest, it tends to burn on the forest floor at a much lower intensity. It returns nutrients to the soil.
Thick black smoke is blanketing the area, reducing visibility. Survey crews are using helicopters to monitor the fire's progress, and now California National Guard Predator drones are being flown in for an almost real-time view of the flames. What's left behind is charred and heavily damaged terrain. Some of the blackened area has not been touched by fire in nearly a century.
When a fire gets into an area that hasn't burned in a long time, and those fuels are so dry and the fuels are so thick, we get a really, really hot fire, and it scorches the earth, and it doesn't return nutrients to the soil as readily, and it actually destroys some of the soil.
The fire started August 17th and has become one of the largest California wildfires on record. It has burned through structures, giant sequoias, and even threatened the main reservoir serving San Francisco. Officials believe they can fully surround the rimfire blaze in 3 weeks, but they expect it to burn until winter rains arrive. If the newest Farmer's Almanac is correct, precipitation will be close to normal in that region. Across the nation, the annual periodical is calling for a winter with below-average temperatures for 2/3 of the country, east of the Continental Divide to the Appalachians, and north and east through New England, with the coldest temperatures in the northern plains to the Great Lakes. However, above normal precipitation is predicted for the southern plains, Midwest, and southeast. But that moisture seems far off for parts of the country predicted to grow the largest corn crop on record. What is now being called a flash drought in the Midwest was exacerbated by extremely high temperatures this week. Several portions of the Corn Belt experienced triple-digit heat, baking what was already a fragile crop. The stress was evident in many areas, and what was green just a week ago has turned brown as the late August heat wave stretched over much of the region. 2013 has been a year of extremes. Snowfall blanketed much of the upper Midwest in early May, and late spring rains delayed planting. Now the quick change in conditions has evaporated the surplus of water, leaving behind a drought. Burlington, Iowa, in the Hawkeye State's southeast corner, already had the wettest spring since 1898 and likely will experience the driest summer on record since, you guessed it, 1898. Several states are also in the same dry-docked boat and are on their way to setting another weather record for the driest August. More than half of the contiguous U.S. is in some form of drought for the first time since early April. This week's drought monitor from the University of Nebraska shows a 5-point increase over last week. The parched conditions are building in the eastern Dakotas, Minnesota, Iowa, and Missouri, while Illinois is drying out as well. Much of the region from western Nebraska through New Mexico remains in the grips of what officials are calling exceptional and extreme drought.
A little more than 5 years ago, the U.S. economy began its recovery from the worst economic downturn since the Great Depression. But there are still those among us who remember that time 80 years ago that crushed the spirit of many Americans. Many lost the family farm, thousands of businesses went bankrupt, and millions were unemployed. President Herbert Hoover's attempts to fix the problem failed, and by 1932, a financially desperate nation elected Franklin Delano Roosevelt. FDR's recovery plan, dubbed the New Deal, was a series of programs designed to jumpstart the economy. Decried by some and praised by others, programs like the Civilian Conservation Corps put millions back to work. Between 1933 and 1942, the boys of the CCC made improvements to the land that can still be seen today. And as Paul Yeager reports, the CCC's legacy runs deeper than the stone shelter houses they left behind.
Many of the lodges, picnic shelters, dams, and trails found in state and federal parks across the U.S. were built 8 decades ago by young men who were in many cases not even old enough to vote. They were members of the Civilian Conservation Corps and often referred to as the boys of the CCC.
They were paid $1 a day, $30 a month. $1 back then was worth $20 a day. You could buy a dozen eggs for 7 cents. New pair of shoes for $1.50, 5 gallons of gas for $1. So it was actually a pretty fair deal. 3 square meals a day, a lot of food. It was a big step up for a lot of guys.
Bill Jamerson has spent a lot of time researching and interviewing the young men who were part of the federal conservation effort that stretched across the United States. He has written a book called Big Shoulders, produced the documentary Camp Forgotten, and performs on the CD Crazy Khaki Kids, which is a collection of songs he wrote about life in the Civilian Conservation Corps.
I planted about 10,000 trees. I did it all on bended knees. Now we're on the road and weather-bound. A lot of people become a little teary-eyed sometimes in my programs. These are heartfelt stories. Abject poverty really brings families together. And people in my audience, anyone in their 70s or 80s, they know how hard it was and what they struggled. And these stories bring back memories. They bring back memories.
In 1933, the United States was suffering through the Great Depression, a time when stocks lost 89% of their value and nearly 1 in 4 Americans were out of work. Many voters felt it was time for a new deal from a new president. Franklin Delano Roosevelt became that new president, and in his first month in office, he created a number of back-to-work programs known as the New Deal.
Brother, can you spare a dime?
The Civilian Conservation Corps, or CCC, was one of the first New Deal programs that made the federal government the employer of last resort.
Times was rough. My dad had died, and my mother, I and my brother was still at home, and you couldn't find a job or anything, and we had lost the farm. My dad had spent his lifetime saving up a little to buy a farm, and you need eating money. My mother needed eating money.
I'm going down to DCCC.
Only single men between the ages of 18 and 25, whose families were on relief, were eligible to join the Civilian Conservation Corps, A CCC boy received room and board, clothing, training, and a monthly paycheck of $30, 25 of which was sent home to his family.
After inspecting Skyland, the Commander-in-Chief takes a seat at the head of the table to eat with the boys, and he enjoys every bite of the plain, wholesome food furnished at the camp.
It's very good to be here at these Virginia CCC camps. I wish I could see them all over the country. I wish that I could take a couple of months off from the White House and come down here and live with them, because I know I'd get full of health the way they have. The only difference is that they've put on an average of about 12 pounds apiece since they got here, and I'm trying to take off 12 pounds.
Despite its name, the Civilian Conservation Corps was in many ways a military organization. U.S. Army officers commanded the camps. Even the equipment was military, with much of it, including the uniforms, being World War I surplus. A typical day in a CCC camp started with reveille at 6 a.m., followed by roll call, calisthenics, breakfast, and then cleanup. At 8 a.m. sharp, the work began.
They would take us down to a big area there where we all lined up, and the government would turn us over to the state to go to work for the state. And it was all state work from then on till 4 o'clock in the afternoon, then they turned you back over to the government again.
The purpose of the CCC was to help the nation's human resources while simultaneously improving America's natural resources. The work of the Civilian Conservation Corps extended well beyond the many stone structures found in state parks today across the United States. Often referred to as Roosevelt's Tree Army, the work of CCC boys extended to projects including reforestation, revitalization of overworked agricultural land, and preventing soil erosion. In fact, 75% of CCC work projects were administered by the Department of Agriculture. Besides fighting fires, erecting more than 3,000 fire towers, and planting 3 billion trees, CCC boys constructed dams, built irrigation canals that provided essential water to western farms, and dug ditches that drained more than 84 million acres of agricultural land.
We were in a soil conservation group, and there was lots of shovel work involved. I think we had one little cat that they could use for moving larger quantities or heavy rocks and stuff like that. But most of it was done by hand with picks and shovels. I grew up in a hurry, I can tell you that.
During the Great Depression, the CCC provided economic relief to families by putting approximately 3 million young men to work. It gave the CCC boys the tools they would need to become successes later in life. And the CCC gave the nation improvements to natural and agricultural resources that are still visible across America's landscape 80 years later.
I look at it now, and it was probably the best thing that ever happened to us. Us young people then that didn't have a job, and I think it was a good deal. I think Franklin Roosevelt knew what he was doing.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
At the beginning of the week, action on LaSalle Street could best be described as a weather market, but prices fell back just before the start of the holiday weekend. Despite the heat, traders are well aware the point is rapidly approaching where high temperatures will have little effect on the harvest. For the week, December wheat gained 8 cents, while the nearby corn contract moved 12 cents higher. Soybeans traded in the weather market saw the new crop contract rising nearly 30 cents. Nearby meal prices increased $4.20 per ton. In the softs, cotton traded in a sideways fashion as the December contract fell 60 cents per hundredweight. In the dairy market, September Class 3 milk rose 51 cents, while the October contract gained 42 cents. Over in livestock, October cattle gained 10 cents, nearby feeders also gained a dime, and the October lean hog contract posted a weekly gain of $2.52. In the financials, the euro lost 176 basis points against the dollar. Crude oil gained $1.23 per barrel. COMEX gold advanced 30 cents per ounce, and the Goldman Sachs Commodity Index gained 7 points to settle at 655.50. Here now to lend us his insight on these and other trends is one of our senior market analysts, John Roach. John, welcome back.
Thanks, Mike. Nice to be here.
Well, we're glad to have you. A big story this week, internationally, of course, has been Syria, the chemical attack, and what the U.S.'s response is going to be. Is that going to be a major factor on the markets as we roll into this next week, 2 weeks from now, do you think?
It certainly could be. It depends on what the response is and then what the response is to the response. The energy market rallied sharply and then slid back a little bit toward the end of the week when nothing actually had happened so far. But it's an uncertainty in an area of volatility or a volatile area of the world. And whenever you have that, you tend to put upward pressure on the energies and the precious metals.
And so headlines are going to continue to drive those two markets, especially as we work through this situation.
Absolutely. You also put a little fear over into the equity markets, and you make everybody just a little bit uncertain as to whether to take positions or exit positions.
All right. Well, it'll be something that I think nationally we'll have to keep an eye on for sure. As we take a look at the grain market, we did see wheat rise this week. There is still a big global crop. Where do you think, how does the future look for the wheat market?
We do have a big global crop of wheat. We've got a good crop, or produced a good crop in the United States, but we're working through that. We've seen a big production in the Black Seas region, the former Soviet Union area, and they've been rapidly selling that crop out. That's held pressure on the market. As they move through that crop, we would anticipate that would will move as they get moved through that crop. We look for prices to start to firm. In reality, the supplies will be tightened this year. It's the only crop that actually ending stocks will be tighter this year as a percentage of usage compared to prior years. So it's actually an improving fundamental situation. We just can't see it yet because of all the competition coming out of the Black Sea region. They're just discounting the prices right now, and that's going to continue until they finally get move through that production.
Probably going to move through that production towards the start of the new year.
It's going to take all the way through this calendar. That's exactly right.
All right. Now, as we take a look at corn, we saw corn spike on Monday as we started to digest this big dome of hot air over the Midwest, and then it traded sideways to a little down throughout the week. Where do you see corn going in the future, and how does this year's potentially large ending stocks, how is that going to affect us more longer term in the corn market?
The people in Chicago were bearish on corn, and they have been for some time. If you recall, a year ago, we were trading $8 corn. And so from $8 corn all the way down into the fours, I mean, it's been a big bear market. The speculative trade has made a lot of money on the short side, and they continue to favor the short side of that market on all rallies. They're getting ammunition from the government reports that showed a monster crop growing. It was reduced on the last USDA report, but then Pro Farmer Tour went out and found big yields again. We're getting reports from the field, early harvest in some of the areas where they've had good moisture, big yields coming again. So there's plenty of ammunition for the spec guys in Chicago to continue to want to press on the market. And yet old crop supplies are extremely tight. The users have very little inventory on hand and almost no inventory bought for the new crop. Farmers, in addition, have no inventory for the new crop sold. Very few farmers have sold the numbers of bushels that they would normally have sold by this time of year. Prices just never got up high enough to interest them. So what the market has to do is it has to get through this time frame prior to the main part of the harvest and figure out what do we have in the field. And after a week of extremely warm temperatures, actually several weeks of very little rainfall in many areas, farmers really don't know what they have in the field. They've become very less certain than what they were 2 or 3 weeks ago. The prices are still very low relative to where their needs are for profitability. And so producers are kind of stuck in a spot where they don't know what to do. They don't like it, so they're not selling. Users are stuck in a spot where they need to buy grain for the new year, but they think the crop looks big, and so they're trying to be patient, and there's nothing really being offered to them in quantity. Overseas buyers have been a little more aggressive. We have record corn sales on the books, and so here we are in kind of in a middle of a poker game, trying to figure out, okay, what's the next card going to be? Are we going to find out that the crop has actually been reduced more than the people in Chicago were thinking? And I'm in that camp. I think the crop is a little smaller than is currently being traded in Chicago. I think the users will blink first. I think that the corn market is too cheap. I think cash corn values for delivery into the main part of harvest will rise, not decline, as we move into that harvest period. I think that as we get into that period of time, it may well be the basis in carrying charges that have to do a lot of the work, and I anticipate that we'll see firmer prices and better price opportunities than what we have today.
So we'll see the futures market continue to hold with the specs being short and the end users trying to figure out what to do, but the cash market could be carrying the weight as we roll through harvest like it did throughout the summer.
It actually did all summer long, and if we go back, it actually has done it for many months, quite frankly. Basis levels have been very strong for many months as it took strong bids to move grain out of farmers' hands. I think that's going to continue. And just a couple of months ago, people thought just the opposite. They thought there's going to be so much corn that it would really pressure basis at harvest. I think that's changed. I think that the flat price that is being offered right now, there will not be enough volume of corn trade at that price to satisfy the user. The user finally can make some money. Whether you're an ethanol producer or whether you're a livestock producer, however you're using corn, you finally have an opportunity to make some margins, and you'd like to get some corn booked so that you can take advantage of those margins. And I think that the user will do what they need to do to get some of that corn bought. They're not going to go crazy. We're not going to have really high prices, but we're going to have the prices necessary to get grain to move out of farmers' hands.
Now, before we let you go on corn, for a end user's perspective, as a hedge, seeing the future staying low until we get through harvest, would this be a good time to put some sales on the board, or to make some purchases on the board, rather, in anticipation that the market's going to catch on to a smaller crop and we'll see the futures rise into December, do you think?
If I were a user, I'd be trying to accumulate inventory on every little dip in the market. I would look at these price levels and say, the low is probably in this market, and we're not very far off of that low. I'd be taking advantage of every little dip.
All right, now let's take a look at soybeans. Again, we've seen record exports of old crop beans. As we work into the new crop, we're in a heat wave in August, the opposite of what we saw last year. What are your thoughts on the soybean market?
Well, people tell me the soybean crop is probably in more jeopardy on this hot weather and dry conditions than even the corn crop. That we're now in that pod filling stage, and we really need the moisture badly. I spent the last couple of weeks here in the Midwest and over at the Farm Progress Show here the middle part of this week, and I talked to farmer after farmer who's just very concerned about their bean crop. They really don't know how bad the impact is going to be, but the worries are great, and my presumption is if we don't see surprising rains, because quite frankly they're not called for. So unless we see surprising rains, we're going to see some further reductions in the size of this crop. We already are looking at relatively tight supplies for this next year, and so I think U.S. supplies are going to be tight enough to maintain relatively high price levels on beans. Now, the South American crop is also growing at the same time. South American currency values are cheap. The producers there are not able to make any money on corn at these values. They're going to plant a lot of beans. The estimates are 6% more beans in Brazil, maybe even as much as 8% more beans in Brazil. So there's going to be a lot of competition in the Southern Hemisphere. Their crop, they're going to need to raise a big crop. We're going to need it. So we'll have chances for weather scares. So the bean market overall has turned into a rather positive situation because of these weather conditions.
So quick advice to producers, if they haven't made sales up to this point, probably better holding off until we work through harvest and see the supply start to tighten?
Well, if you're a producer who has been catching some of the rains and you can see the crop out there and you feel comfortable with the crop and you like these prices, it's okay. There's nothing wrong with making some sales here, but you make sales with the eye idea that prices are not going to fall out of bed. They could fall out of bed in the midst of a rain, but the prices in general through the year are going to be relatively firm.
Should stay strong.
Should stay strong.
Now, as we take a look at the meats, we're talking end users needing to acquire corn. Let's talk fat cattle. We have seen some relative strength both on the board and in cash prices, up a couple dollars for the last 2 weeks. Is that going to continue?
We think we're about fully priced in the cattle market. I mean, this is the kind of the tough time of year here for the beef market. The kids are back in school, and it's expensive to put the kids back in school, and so moms look for a way to ease the budget a little bit, and that tends to slow down the demand for beef a little bit.
All right, now as we take a look at the feeder market, as we saw a pretty good sell-off on Monday as corn prices skyrocketed. Since then, they've kind of traded sideways, climbed up a little bit. Is that going to continue? Is there still more room to climb in feeders with corn around the $5 level for December?
I think there still is. The pasture conditions are good, and there's been some change here in in the central part of the Midwest. But if you go to the fringe areas where a lot of the pastures are located, the pasture conditions are good. We're seeing some expansion in the herd a little bit. We saw in this last cattle on feed report the placement numbers were down. We think that's some heifers going back out into the pasture. So we think feeder values will tend to be firm as we move out here through this fall period.
All right, move out to the fall through about December. Do you think we'll see continued strength?
I would think so, unless for some reason or another the corn market were to get it really excited. And I'm not really thinking that the corn market gets overly excited in here. We just think firmer prices.
All right. Now, as you mentioned, we are seeing moms look for perhaps a more affordable supply of protein. As we look at the pork market, then, is that going to afford some continued strength as we look to the next month or so?
Well, we still have that seasonal downtrend in the pork business. Normal seasonal decline, we're about halfway through it, is about $12, and we're down about $8. So we're still in that decline period, and we're about halfway through it. So we're expecting some further pressure here over time, but we think in general the market's okay.
All right. Well, thank you so much, John. I appreciate you being with us. That wraps up this edition of Market to Market. But John and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. Be sure to join us again next week when we'll take a look at how one noted meteorologist is using the historical record to help predict future weather trends. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.